Welcome back. It's been almost 2 years since private equity giant Blackstone took over Mphasis. Since then, the stock has doubled, the revenue trajectory has improved. I caught up with the CEO and whole-time director of Mphasis, Nitin Rakesh, and began by asking him if the company can continue to sustain double-digit revenue growth going ahead. Listen in.
We started FY19 on a pretty strong footing. We talked about accelerating our order book last year. We signed up more than 550 million in TCV. Some of that is playing out this year. So our Q1 exit run rate is pretty strong. So we feel good about the fact that this year should be a good above market growth year for us. I think two of our core segments, DXC, HP, and Direct Core, continue to be at or above market growth, which augurs really well for our overall growth for FY19 and of course in 20.
Okay, let's break up your business into the key revenue drivers. One is Direct Core, roughly 55% of your revenues. That will continue to see above industry growth rates. And secondly, your HP DXC channel, which has been a big growth driver, at least for the last few quarters. An investor concern there is that there perhaps is limited visibility for a double-digit revenue growth beyond FY19 for your HP DXC channel. How would you respond to that?
Sure. So let me take Direct Core first, which is kind of the core, largest part of our business and most easily comparable to third-party IT services. That business actually has had a track record of growing above market for almost 4 or 5 years in a row and continues to be above market growth this year. It's been the key driver of our growth, very heavily focused on banking, financial services, insurance. We've added some new engines of growth in terms of verticals. We started to see growth coming out of Europe. So I think it's got multiple engines of growth firing between strategic accounts, Blackstone portfolio, Europe growth, and new logos. Then if we talk about the DXC HP channel, I think the concern is valid because that channel has had a history of tumultuous past, especially from the 2010-11 timeframe. So I understand the concerns that investors have had, analysts have had. But keep in mind, this is a different era. Right? There are 4 distinct relationships under that one channel. There's DXC, there's HPE, there's HPI, and there's Micro Focus. Of course, we are most mature in, relatively most mature in DXC because we've actually been in that group the longest, the enterprise services division that used to be with HP. But even there, we are only 1% of their overall revenue. Right? So the runway for growth is pretty much there. With HPE, HPI, and Micro Focus, I think we've just barely scratched the surface because they're all Fortune 500 companies. Our wallet share there is very low, actually extremely low single digits. So I do believe that there's a long opportunity for us to continue to execute across that channel and continue to make sure that the channel, at least for the foreseeable future, stays at or above market growth.
Okay. These two businesses roughly contribute 80% and they are growth additive in your words.
Yes.
The other businesses are a bit growth dilutive. You're talking about digital risk, your products business, as well as the India business. Share the outlook on these 3.
So I think digital risk is an interesting case of transformation underway. We had a pretty dire situation in that business about 1.5 years ago. Obviously, the macro environment in the US is still headwinded because we actually work on servicing mortgage originations and refinances. Because of the interest rate environment in the US, that business is very headwinded. But we're very glad that we've actually managed to get into near adjacencies, cross-sell IT services from Mphasis into those clients, and really stabilized and actually marginally grown the top line in the last 4 quarters. So we guided to a $28 to $38 million revenue range there. We are above that range. We feel good about that. But the other important thing is that while we've done that, we've also transformed the profitability profile of that business. It went from being mid-single digits, actually it was trending downwards. We've now brought it to healthy double digits.
High single-digit revenue as well as double-digit margin kind of a guidance for digital risk?
I would say mid to high single-digit revenue and continue to execute on the cross-sell opportunity.
Let me come to your margins. Last year, your margin guidance band was 14 to 16%. You upped it to 15 to 17%. Now there is a currency tailwind which will benefit your margins in the coming year. Are margins trending upwards?
Yeah, I think our long-term aspirational goal is for the company is continue to grow above market and have a continuous improvement in operating margin profile. And that's what we're executing on. As you see this year is all about consistent growth. And as we do that, can we continue to find ways to expand our operating margin? And that's kind of the guidance we have. We are trending towards the upper end of the current year range of 15 to 17. We're still keeping some gunpowder dry to continue to invest in the business. So we are not changing the range yet. But we feel good about the way we're executing on the margin levers, especially things like pyramid optimization, fixed price, pricing environment, ride shoring.
The other potential growth driver can be the Blackstone portfolio. Give us a sense of the kind of opportunity that you're looking to target from the Blackstone portfolio group of companies.
So I think it's I would say another long-term opportunity. We just scratched the surface with the first few deals last year. Can we continue that run rate? Can we find ways to make this a meaningful portion of our revenue within direct core? The answer is yes. It's really all about how we execute, because this does require a lot of execution, because there are lots and lots of companies that we actually end up talking to.
Yes. But give us a sense of the kind of opportunity it may be. You were telling me.
Yeah, I think it's $1.5 billion to $2 billion annual IT spend.
Yeah. Question and you're the only IT company in the Blackstone
in the portfolio. But again, these companies operate on a federated manner, so they do work with a lot of our competitors. If I look at the $1.5 billion to $2 billion annual spend, question really is, can we get to a 10%, 15%? Again, sky's the limit. Yeah. But really, let's first get to double digits. We're still very, very low single digits right now.
Any acquisitions and any plans to increase the dividend payout ratio from the current 50%?
Yeah, I think, again, dividend payout is probably going to be consistent. The reason we're using buyback is kind of a one-time return back to shareholders, probably a more efficient way to do it. And it's probably more case by case. Acquisition plans are very much on the table. We've looked at 3 vectors of acquisitions: capability, adding to our verticals or sub-verticals, and adding to our geographic mix. And as we speak, we're fairly actively engaged on all 3 vectors to identify, what the right fit is. Even after the buyback and the dividend, we still think we have enough gunpowder dry to kind of continue to execute our plans on M&A. Hopefully, FY19, we should be able to see something happen. But again, these things, when they happen, they happen.
Okay. And how big could the acquisition be?
I think typically no more than 10, 15, 20% of revenue, because that's easy to absorb, easy to integrate.
That's still $150 to $200 million of...
Again, that's the upper end of the range I'm saying, because that's the kind of, if you look at our cash position, that's the kind of planning we have right now.
Okay, so that is Mphasis. Let me tell you some things that he's not spoken before that he indicated in the interview. One is the long-term goal of the company is to keep growing above the industry growth rate. So it's not going to end at FY19. They want to do that even in 20 and 21 thereafter. Secondly is the continuous improvement in the margin trajectory. Last year, this year they upped the margin band guidance to 15 to 17% versus 14 to 16% last year. And now the company indicates that X of currency, they want to keep improving it because they have some optimization, they have some, margin, benefits which could come through from pyramid optimization, etc. And finally, there's perhaps an acquisition in FY19. He said so himself that, we could look to close it in FY19. So that is also going to be something very interesting to watch. And the stock is reacting, positively as we speak.
Absolutely, Rima. 3 out of 3 actually in this show itself. 3 IT companies have spoken to us, and all 3 of them, it seems that shareholders and retail audience and all our viewers, they like what they're saying. Saxoft is at the high point of the day. Sonata Software as well is at the high point of the day. And Mphasis, that's the big one actually. And there, as Rima says, is they're looking to outpace the industry for the next few years, and a possible acquisition as well on the cards. And that stock as well at the high point of the day as we speak. Let's slip into a short break. When you come back, we'll get you more on the markets as well as stock specific action.